If you walked into any trading floor in New York right now, you'd feel an eerie silence, not because there's nothing to do, but because of fear. At this very moment, the fate of global markets hangs by a thread, the Nvidia Q3 earnings report due in less than a week. But this isn't just another earnings release. With the Nasdaq wobbling, Google's Gemini 3 failing to ignite excitement, and US Treasury yields stubbornly high, this report is the autopsy of the 3-year AI supercycle. Yes, you heard that right. I used the word autopsy. Over the past week, capital has been fleeing tech giants at an alarming pace. Smart money smells smoke. In this video, we'll break down why the economic logic behind AI is unraveling and how you can grab your life, preserve your money, and get to safety when the tide goes out. Buckle up, we're diving into deep waters. First, let's understand what Wall Street is truly afraid of. Is AI losing steam? Of course not. What they fear is simple. The math no longer adds up. Let me give you a number. $250 billion. That's the combined capital expenditure. Capex, Microsoft, Google, Amazon, and Meta are expected to spend in 2025 to dominate the AI race. That's more than Intel's entire market cap. Where does this money go? Mostly into data center GPUs sold by Jensen Huang's Nvidia. Think of it like this. You run a lemonade stand. To sell more lemonade, you invest millions in a diamond-encrusted juicer. That juicer? That's today's AI data center. The buyers? Microsoft, Google, Amazon, Meta. The seller? Nvidia's Jensen Huang. According to the latest forecasts, these 4 hyperscalers will spend over $250 billion in 2025 more than the entire Apollo moon program cost in today's dollars. But here's the question. How's the lemonade selling? This is the so-called ROI wall. Wall Street analysts are scouring for AI-driven revenue growth. Yes, Copilot charges $20 a month, Gemini Advanced has a subscription fee, but when you add up these small streams, can they cover the $250 billion in depreciation, power, and maintenance costs? The answer? No. Not even close. This is the root of the panic. It's a game of chicken. Every CEO knows the math doesn't work, but no one dares stop spending because stopping means losing the AI arms race. But shareholders are losing patience. A recent Sequoia Capital report has been circulating on Wall Street asking a $600 billion question, where's the AI revenue? If Nvidia's earnings show even one major client cutting orders even just to reduce inventory, the entire house of cards built on infinite growth assumptions could collapse. Some will argue, don't be so pessimistic, technology is still exploding. Look at Google's Gemini 3. As a tech believer, I admit it's impressive. Its deep think mode is remarkable. But as an investor, I see something else. Diminishing marginal returns. This is a brutal economic law. When GPT-4 launched, it felt like magic. We were willing to pay for it. When Gemini 1.5 arrived, we said, nice. When Gemini 3 dropped, the market reaction? A slight stock bump, then a retreat. Why? Because while the model improved, it didn't deliver a game-changing experience for most users. Yet the compute costs and power consumption behind that tiny leap have skyrocketed. It's like dumping expensive rocket fuel into a race car, only to go from 300 miles per hour to 305 miles per hour. Investors are realizing we may have already picked all the low-hanging fruit in AI. If the next-gen models GPT-5 or Gemini 4 can't prove they can replace half of human labor and generate massive economic value, then today's valuation multiples 50x, 60x PE ratios are nothing but mirages. This brings us to the critical moment next week. If you own Nvidia or any semiconductor stocks, AMD, ASML, TSM, or even China's optical module plays, grab your notebook. This isn't just about your portfolio, it's about your view of the next 3 years of the tech cycle. When the earnings drop, Bloomberg and CNBC will scream headlines like revenue beats expectations or profits soar. Don't believe them. That's retail investor comfort food. In an era of algorithmic trading and high-frequency quant strategies, surface-level revenue and EPS are no longer the sole drivers of stock moves. The market has already priced in perfection. Nvidia today is like a tightrope walker on a unicycle, carrying a 1,000-pound load. Just staying upright isn't enough, it must dance. You need to think like a Wall Street fox. Cut through the fog and focus on 3 hidden metrics, the real battlegrounds for bulls and bears. The Blackwell delay and the heating narrative. Blackwell B200, GB200, is NVIDIA's next crown jewel. The entire AI supply chain's valuation for the next year hinges on its mass production. If Jensen Huang uses phrases like yield challenges, supply constraints in advanced packaging, or worst of all, thermal dissipation adjustments during the earnings call, sound the alarm. Why? Because supply chain whispers aren't encouraging. The GB200 NVL72 rack, the compute beast, is reportedly struggling with liquid cooling leaks and uneven heat distribution due to extreme power density. If Huang admits that Blackwell's rollout is delayed from Q1 2025 to late 2025 due to thermal issues or co-vessel packaging bottlenecks, that's a massive sell signal. Wall Street models assume a seamless transition to Blackwell. A delay means Microsoft and Meta could face a procurement gap in Q1 and Q2. They won't buy H100S, too outdated, but can't get B200S. This could trigger a rare quarterly revenue decline for NVIDIA unacceptable at current valuations. 2. Gross margin compression. NVIDIA's gross margins have soared past 75%, even nearing 78%. In hardware, that's robbery on par with software or even illicit drugs. But that's also its Achilles heel. Extremes invite reversal. 75% margins were built on extreme supply scarcity. Now, cracks are showing. Upstream costs rising. TSMC isn't charitable. CEO C.C. Wei has already signaled price hikes for 3 nanometers and 4 nanometers nodes. Memory squeeze. HBM3E high bandwidth memory is the lung capacity of AI chips. SK Hynix and Micron Control, pricing and prices are surging. Yield losses. Blackwell's chiplet design increases packaging complexity. Every defective chip drags down margins. If NVIDIA's gross margin dips even from 75% to 72%, it may seem minor to retail investors, but to institutions, it signals the end of the dominance premium. Once the halo cracks, the entire semiconductor sector, including Broadcom, AMD, faces valuation derating. 3. The whisper number game. This is the most dangerous, most deceptive battlefield. The consensus estimate in analyst reports might be $35 billion in revenue. That's the public number. But in hedge fund chat rooms and Manhattan lunch tables, the real benchmark is the whisper number, often $37 billion or even $38 billion. This creates a brutal asymmetry. Hit $35 billion meets consensus, stock tanks missed whisper. Hit $36.5 billion beats consensus, stock flat or dips barely past. Only $38 plus billion with a stellar guidance can prevent a meltdown. That's nearly impossible. When a company hits $3 trillion, expecting it to grow like a startup defies physics. It's like asking an elephant to dance like a gazelle. All right, I know I've given you plenty to worry about, but as I always say, in this market, we don't predict the future, we prepare for it. If the AI bubble deflates, will money vanish? No, it will just move. As individual investors, we must follow smart money into sector rotation. Here are 3 safe havens where institutional money is flowing. Safe haven, 1 utilities, 2 the real AI play. Ironically, no matter who wins in AI, Microsoft or Google, they all need electricity. U.S. Data center power demand is exploding. Companies with nuclear capacity or stable grid assets are now growth stocks. This is the pick and shovel play extended. If NVIDIA sells shovels, utilities sell water. You can skip the shovel, but you can't skip water. Safe haven 2, defense tech. Look at the world map. The Middle East, Eastern Europe, geopolitical tensions are rising. U.S. and European defense budgets are non-negotiable. And modern defense isn't tanks, it's drone defense systems, cybersecurity. Palantir, Anduril if it goes public, and traditional defense contractors have long-term government contracts. In uncertain times, that's the ultimate moat. Safe haven 3, cash and short-term bonds. Cash is king. Don't forget, Fed rate cut expectations for December are fading. Cash isn't trash. Earning 4.5% risk-free while watching others run through a fire is a winning strategy. Cash isn't just yield, it's optionality. It lets you strike when panic selling creates blood in the streets bargains. To close, let me share a story. In 1929, Joseph Kennedy, JFK's father, made a fortune by selling all his stocks before the crash. When asked why, he said, "When the shoeshine boy starts giving me stock tips, I know it's time to get out." Now, look around you. Is your barber, your Uber driver, even your non-investing neighbor talking about Nvidia? Asking if they should buy AI? I'm not saying AI is fake. The internet was real, but so was the 2000.com crash. Amazon survived. Pets.com didn't. On this cold November day in 2025, protecting your principal is 10,000 times more important than chasing the last 10% of gains. If the market rallies after earnings, you might miss a little upside. But if it crashes and you're prepared, you win the game. Stay sharp, stay independent. If this video saved you money or just helped you stay calm, please like and subscribe. I'll be here, walking through the storm with you. Until next time.